Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to another one of our sample trade videos. This one is a real-life example with Celestica Inc. listed on the New York Stock Exchange under the ticker symbol CLS. Now, it's actually two cash-secured put trades, defensive in nature, that I executed this past Monday, September 8th, 2025, and expired just a few minutes ago on Friday, September 12th, of course, 4 p.m. Eastern time. So it's around 4:30 right now, and the trade ended about a half hour ago. All right, so as always, I took this trade from one of our premium reports, this one from our stock report. And let me first show you why I selected CLS. And this is a screenshot from our stock screen and watch list. I highlighted CLS in the yellow row here. And let's start all the way to the left. You note that it's in bold. That means all the technical parameters were bullish, every one of them. Another thing that caught my eye was that it's listed as number one on the IBD 50, meaning it's an elite performer from both technical and fundamental perspectives. Now, it's in the electronics industry segment, currently ranked A. It was ranked A last week as well. You could see the mean analyst rating was 1.55, which is outstanding because 1 is the best and 5 is the worst. And the on-balance volume has an up arrow, meaning more cash flowing in on up days than on down days. Now let's move over here to the implied volatility, 63.4%. Now, let me just stop right now and say that's high, okay? Which means nice returns, but it's high. So we have to worry about the downside risk. And that's the reason why when I set up these trades, as you'll see in a couple of slides, I did them in a very, very defensive way, but still generated very significant initial returns. Now, the option liquidity was adequate. The earnings report was not in the way. Weeklies were available, obviously, because I'm doing a weekly here. And it's been on our list now for 13 consecutive weeks, which means that it's been very strong. It's very difficult to pass all the screens you see on this blue bar on the top. And Celestica has done that for 13 weeks. Okay, now I want to show you a 3-month comparative chart with the S&P 500. Celestica is this kind of orange line on the top. You can see it's really outperformed the S&P over the last 3 months substantially. Now, looking at the technical parameters we use in the BCI methodology, number one are the exponential moving averages, identifying trend. You see the shorter term 20-day EMA is above the longer term red line. 100-day EMA, the price bars are at or above the 20-day EMA, very bullish trend. Number two is the MACD histogram, which is a trend and momentum indicator. The end of the green arrow shows that it's popped up above the zero line, another bullish signal. Number three, we have this blue arrow, is the stochastic oscillator, this black line here. You don't have to be a genius to see that it is in fact ascending and recently broke through the 20th percentile, which is an especially bullish signal. Now, are all these 1, 2, and 3 indicators meaningful? Yep, because the volume is holding up, number 4. That's why it was in bold, all bullish indicators. Now, when we moved to the option chain on Monday morning, when I checked it out, Celestica had popped up to 250.77 early in the day, but I still liked it. What I looked at was the 225 deep out of the money cash put with a 5-day expiration, and that generated a bid price of 90 cents, $90 a contract. The 230 still deep out of the money, also 5-day expiration, had a bid price of $1.37. So we could use out of the money puts, which offer significant returns, which I'll show you in the next slide, and lots of protection to the downside. Okay, let's take that information, put it into the trade management calculator. On the top, you could see Celestica trading at 250.77. The two strikes were the 225 and 230. The premium's 90 cents, $1.37. I did one contract of each. Now, the spreadsheet tells us that it's a 5-day trade. You already knew that, Monday to Friday. The time value we already stated. Now, let's look at the break-even price points in the yellow cells here. The 250.77 was the starting price. So the break even on the deeper out of the money 225 was 224.10, all the way from 250.77. The 230 was still very low break even, 228.63 from 250.77. All right, what about the returns? Let's first take the 225. We would expect the returns on the 225 deeper out of the money put to be lower than the 230, and it certainly is. In the brown cells here, we have a 5-day return of 0.4%, and that annualizes out to a really nice 29.32%. Now, what if the price of Celestica moves down from 250.77 to below the 225 strike? We take no action to buy back the put, and we purchase it at that discount of 224, break even of 224.10. Well, that represents a 10.64% discount, as you see in the purple cell. Let's look at the 230 strike now. That has a return of 0.6%. It's not as deep out of the money, so the return is higher. That annualizes out to a really, really robust 43.74%. The pink cells here. And the purchase discount, if we buy it at the break-even price of 228.63, is 8.83%, as you see in the blue cell here. So those are the two outcomes, folks. Annualized returns of 29 or 43%, or purchase discounts of almost 9 to 10%. Right? Those are the only two outcomes. Does that mean that we can only make money? No, because if the price drops below the break-even price points, as far down as they are, we can actually start to lose money. Now, here's a broker statement, my broker statement, showing the execution of the trades. One contract at $90, one contract at $137, and those puts expire Friday the 12th today. About a half hour ago. All right, so here's the unrealized status with Celestica at 250.77. We had the 0.4%, the 0.6%. I already told you about that. The break evens 10.64% discount, 8.83% discount, and the two contracts generated in my cash account $227. All right, let's look at now if that, let's say that was my entire portfolio. Well, the spreadsheet, the TMC Trade Management Calculator says, okay, you did in your portfolio two contracts, you generated $227. The amount of capital required to secure those two puts was $45,273. The put strike minus the put premium times 100. And that average portfolio return is 0.5%. And if we were to annualize it, it would annualize out to 52%. So I think you could see now why I say we could take extreme defensive postures and still generate very, very significant returns. Now, if we weren't as defensive, the returns would have been even higher, but the risk to the downside would be even greater. Now, I told you that Celestica had a very high implied volatility. Well, have a look at the roller coaster ride that we took with this stock. You could see where we opened on the left, and it went down, then it went up, and it went consolidated a little bit, and it ended up going down. Okay, it went down to about $241 when it expired. I'll get the exact number in the next slide. But yeah, it went down from 250 to 241 over those 5 days. Wow, a $9 a share loss. How much money did we lose? Well, Celestica closed at 241.77 from 250.77, but both puts expired out of the money and worthless, well above those 230 and 225 strikes, showing you that even though the price of the stock went down dramatically, and we knew it could because of the high implied volatility, because we structured our trades so defensively, we realized our maximum return, which was 0.5%, 52% annualized. So what do we know from this? Well, we know significant returns can be generated with 5-day defensive-oriented cash-secured put trades. And we can align and craft our trades based on what's going on in the market today and your personal risk tolerance. In this particular case, we did capture and realize very, very significant returns in a defensive way. And once again, I have to reiterate, ladies and gentlemen, these are low risk. They are not no risk trades. So that ends another one of our sample trade videos, this one with Celestica Inc. Ladies and gentlemen, I hope you enjoyed this presentation. More importantly, I hope it puts cash in your pockets. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.